We're joined today by Tyler Ballhorn, and he has some thoughts on how to manage a trade once you've made that buy decision. So Tyler, tell us a bit about that.
You know, I think investors and traders, particularly those who are just starting out, will focus on the importance of the entry decision. I did that for the first 8 years of my trading career. And I was a very good stock picker, but I didn't really make a lot of money yet. And the reason is because I was missing out on some other key components of trading well. And I think that there's essentially 5 important factors that you have to focus on if you're going to trade well. First is the entry decision. It is important. But second, and probably the most important element, is risk management. We're not going to be right all the time. The stock market cannot be predicted. Anyone that tells you that it can be predicted is lying to you. And so we have to recognize that some of the time we're going to lose on trades. But what's important is that we control the size of those losses. If you have really big losses and small gains, you're not going to get anywhere, obviously. Even though that sounds obvious, so many people hang on to their losers and let their small losers grow into big losers. And so the second pillar, if you will, is risk management. Always planning to lose when the stock tells you that you've made the wrong decision on the entry. The third thing that's important is emotional control. You know, you have to have a set of rules, but you also have to have the ability to follow those rules. And that really comes down to your emotional attachment to money. If you take too much risk on a trade, you're not going to be able to follow the rules because you get caught up in the emotion of the money that you might lose or the money you might make. And that is a real problem for most investors once they get into trading. The fourth thing, of course, would be the exit decision. You have to have a set of rules that maximizes profit over a large number of trades. What most people try to do is maximize the profit on every single trade. Well, you can't do that. We can't call tops perfectly. And so I try to come up with a set of rules that says, if I do this 10 times, I'm going to maximize my profit over those 10 trades. Not on each individual trade, but over the long term. And the fifth thing, and something that I've found is really important in a difficult market like we've had in 2011, is scaling into a position, adding to your winners. So many people add to their losers. Stock goes down, they average down. Absolutely the worst thing that you can do. Eventually you will go broke doing that. If you have a good stock, one that's working, one that's using or making you a profit, add to that position. It's like if you're at a horse race and the horse is rounding the third corner in the lead by 4 lengths, wouldn't it be great if you could go bet more money on that horse? We can do that in the stock market. You can add more to your positions when they're working. And so when you take those 5 things and have a real solid understanding of those 5 things, now you've got all the components to being a successful trader.
I want to just follow up on some of the signals to exit a stock, either to cut your losses if the buy was a mistake or when it's time to sell and perhaps take profits. What are some of the signals to watch for in those cases?
Well, believe it or not, knowing when to exit at a loss is actually quite easy. I always exit when the stock falls down below support. So if I'm buying at $10 and I can see on a chart that support is at 9, I'm going to plan to lose at 9. I know then that my risk is $1 per share and I can adjust my position size according to that risk. Once a trade starts to work, I use something called reward for risk multiples. Every time it passes through a reward for risk multiple, I'm moving my support price up. So in my example, if I'm buying at 10 and my stop loss is at 9, I've got a risk of 1. If it goes to 11, I've hit a reward of 1. If it goes to 12, I've hit a reward of 2. And I trail my stop accordingly. Now what's important is that those risk-reward multiples be based on the actual volatility of the stock and not some arbitrary number.
Thank you very much, Tyler.
You're welcome.
This is the MoneyShow.com Video Network.